last chapter we're going to talk about is chapter 18. We're talking about revenue recognition. Revenue recognition has actually undergone some changes in the past couple of years. And so while it's actually a very difficult concept, some of the things in revenue recognition are only difficult to apply, and they can't really translate that to an accounting issue. So they have to give you a lot of information. So we're going to talk about these things, the fundamental things, the 5 steps. So you need to know some terminology in this area, and then some things that might be a little bit difficult and some presentation and disclosure issues. Okay, so the first things are that we're going to go through these 5 steps. So make sure you actually go through each of those 5 steps and understand that those are the 5 steps. Again, so one of the reasons we have a new standard is because the International Accounting Standards Board had some revenue recognition standards, and the FASB tries to follow those as much as they can. So that's why we have current changes in that. So generally when we're talking about revenue recognition, we're talking about contracts. So you can go ahead and just read through those. This is what we're really going to talk about. Identify what the contract is. Identify the performance obligations. That's a terminology you need to know, because we'll say revenue is recognized when the performance obligation is satisfied. So a lot of times that's pretty simple. They walk out of the store after paying for your product, so that's the performance obligation. But other times you're building a building for someone else, so when has the performance obligation been satisfied, etc. The transaction price, again, most of that is, in a lot of transactions, pretty simplistic. What the transaction price is, it's because what the sticker that they have on the thing that says what the price is. But in other times when you have different amount of payments based on different amount of satisfaction levels, the transaction price gets a little more complicated, or when they have a warranty attached to it, etc. Allocate the transaction price to the separate performance obligations. So if I sell a TV with a warranty attached, one performance obligation is giving them a TV, the other performance obligation is fulfilling the warranty. So how do we allocate that? And then we recognize the revenue. So this is the important point, that this terminology you need to know and you need to change to, because we usually say when the sale has occurred, but now you have to say when the performance obligation has been satisfied. So that's really what we're going to do. All right, so this is an example. Assume Boeing signs a contract to sell airplanes to Delta Airlines for $1 million, and this is under a contract, so you can say Boeing has signed a contract to deliver it. They only have one performance obligation in this one, to deliver the airplanes, but they could have 2 if they also agreed to maintain the planes, or to separate, then you would have a separate performance obligation. In recent years, our college purchased what's called Genzabar, which is the registration and system that had billing, etc. So it's supposed to be integrated. So that actually has maybe 2 or more performance obligations, because when the university purchased it, they got the software itself, 1 performance obligation. The company agreed to give us regular updates as updates came along, 2nd performance obligation. And the 3rd one, is part of the purchase price, was training of employees to use this service. So that's actually a 3rd performance obligation. So a contract, especially nowadays when things are online and when you get maintenance or updates or that type of thing, you can have several performance obligations. Determine the transaction price. In this case, it's pretty simple, because we only have 1 performance obligation. We don't have to allocate it between the 2, and then allocate it. They say we've only got 1 here. Sorry about that. Can't get it there. And then when performance obligation is satisfied, so when Delta delivers the airplanes, then that performance obligation has been satisfied. Okay. So then we're going to talk about it, and that's where we're going to go through these examples. So the first thing we're going to talk about is an agreement. So let me pause this. So I don't necessarily have these on your handout, but I would write down what you need to write down to remember it. So a contract, hopefully we all know what a contract is, and we all know that it can be written, oral, or implied as customary business practice that you're going to do it. The second step is, as far as, I guess we're still in step one, that what makes a contract a contract. A contract has commercial substance. So we talked about trading assets without commercial substance. Commercial substance basically means you get something of value and you gave something of value. So if it lacks commercial substance, you may have a green car and I have a red car, and I want your red one and you want my green one, and we just switch. We're really not in any different place than we were before, so that might lack commercial substance there. The parties have approved the contract, so we both signed it. The identification of the rights of the parties is established, so you're going to give me your car and I'm going to give you $10,000 or whatever it is, and once I give you give me the $10,000, I also sign over the title. Payment terms are identified, and it is probable that the consideration will be collected. So in this case, we actually do this. This is why we have an allowance for doubtful accounts, because it is this one right there that we're following, that we can book 100,000 of accounts receivable, but we have to estimate the amount that won't be collected because it is not probable that all of it will be collected. So if you have a situation with a contract that you have that, or overall, let me back up a second. Sometimes students have difficulty because of micro versus macro situations. So micro means you're applying it to every party. So if we're talking about 100,000 customers, a micro level would be picking out which customer did it. So if I sell to customer B today, I want to know if they are going to pay me. And sometimes you can't do it on a micro level. You have to do it on a macro level, which means of my 100,000 customers, it's probable that 10% won't pay me. And so I don't have to identify specifically who they are. But so certainly, usually these probable consideration will be collected. Most of those, we're looking at it at a macro level of overall of all these customers, how many will pay me and how many won't pay me, and then I can make an estimate of it. There are times when you do it on a micro level of, if I sell it to a high-risk customer, I may wait to recognize my revenue until that high-risk customer actually pays me the cash, because collection is not definitely known. So you can put it on a customer by customer basis. Generally, we put it on an overall basis, and we'll talk about those. Okay, so notice this is this one. So a lot of these you're going to say, okay, well, this is silly, this is really redundant. We've talked about this probably in financial accounting. So honestly, enjoy the fact that we have to go through basic, easy transactions for you to understand it. But we really need to show how a basic, easy transaction kind of automatically fulfills the obligations or the steps of it. So when we get to a harder transaction, we can apply the rules to it. So on March 1st, Margot Company enters into a contract to transfer a product to Sun Yun. On July 31st, the contract is structured such that they were required to pay the full contract price of $5,000 on October 31st. The cost of the goods transfers. Margot delivers the product on July 31st. So on July 31st is when we record our journal entry. Honestly, technically, we would record the journal entry when all the paperwork gets there. But if year end happens to happen on July 31st, even if we would normally make it on August something or other when we got all the paperwork, we would actually need to force it into the correct year. So we're not necessarily concerned about the exact day it is recorded on. We're worried about the year that it gets recorded in. So let's say they're going to pay it on August 31st. And let's say this was, instead of July 31st, it was August 15th. Sometimes you actually may wait and make the journal entry when all the paperwork gets in there. But let's pretend that we make our journal entries on the exact date that it happened. We don't backdate anything or make a adjusting entry for it. So on July 31st, I have accounts receivable, sales, cost of goods sold, inventory. You've done this throughout, so hopefully you can guess what the entry to record the collection on the accounts receivable is. Oops, gotta get that. So cash and accounts receivable. But the problem is, I want you to apply it to these steps. They've made a contract. They have one performance obligation that they're going to do. They're going to pay $5,000 for $3,000 worth of goods. The transaction price is $5,000. I don't have more than one performance obligation, and I recognize the revenue when it's delivered, which is July 31st. Okay, we'll assume sometimes you'll have issues with FOB shipping point and FOB destination being two different days. You don't necessarily need to worry about that particular case because this one tells us that delivered all the product on July 31st. We can assume they shipped it on July 31st also. Okay, so you have those two journal entries. A performance obligation is a distinct product or service to a customer. So the product or service is distinct when a customer is able to benefit from a good or service on its own or together with other readily available resources. So sometimes this is hard to figure out. Do we have separate performance obligations? So what are some examples of performance obligations? When they need to be distinct items. And so hopefully they'll give me some examples on that. Oh. Okay, so write down those from slide 15. Okay, so let's go to this next one, which will actually, you might want to go back up here after you go through these. Assume that General Motors sells an automobile to Marquardt auto dealers at a price that includes 6 months of telematics services, such as navigation and remote diagnostics. These telematics services are regularly sold on a standalone basis by General Motors for a monthly fee. After the 6-month period, the customer can renew these services on a fee basis with General Motors. The question is whether General Motors sold one or two products. So I don't know if you or your parents or someone you know has ever bought a new car, but sometimes they'll get like 6 months free of Sirius radio. Mine did. When I bought my car, I had got 6 months of radio, and then after that 6 months, they call you nonstop to try to get you to subscribe to from then on. But the question is, are they, how many performance obligations are there? So it appears that it is, we sell two goods, the automobile and the telematic services. Both are distinct. They can be sold separately, and they're not interdependent. In other words, you don't have to buy one without the other. So think about the bonds that were convertible, how the bond and the conversion part, you couldn't separate it. So you recorded them as one, whereas the bonds with warrants attached, you could separate them, so you recorded it as two. So that's the same thing we're going to do in this type of thing. So, so how many performance obligations are there? In this case, there are two because both are distinct and they can be sold separately and they're not independent. However, if we go over here and read through this one, they have a license, a customer relationship software to Lopez Company. In addition to providing the software itself, they promise to provide consulting services by extensively customizing the software to Lopez information technology environment for a total consideration of $600,000. In this case, they're providing a significant service by integrating the goods and services, the license and the consulting service into one combined item for which Lopez has contracted. In addition, their software is significantly customized by Softtech in accordance with specifications negotiated by Lopez. Do these facts describe a single or separate performance obligation? And notice the license and consulting services are distinct but interdependent, so they're one performance obligation. So in this case, it's one. So in the case that I talked to at the first about QU and its software, I know some of the details of it. I don't know a lot of the details of it, so I'll just make up some items. I do know that you can buy the software package, and with that software package comes some automatic updates and some training. But I also know that the training you can buy different levels. So there's a initial training that actually comes with it, and then there's some additional training packages that you can purchase with the software. So the ones that are all part of actually utilizing the software is one performance obligation, and the ones that you could purchase separately would be a second performance obligation. The updates on it probably are with the purchase of the software itself, although if you've ever bought a software for your computer at home, sometimes you actually only buy updates for a certain period of time, like 1 year, and then you have to buy more after that. So the whatever if you buy your TurboTax or any tax software package online, you actually buy the package which is empty, which you log on and you download the software. So the empty package or the CD that comes with it would be part of the performance obligation of the updates. Other times it'll be separate. So I don't know the details of the software package we use, but my guess is that the purchase price came with a certain amount of updates for a period of time, and after which, maybe if you wanted to buy 2-year updates instead of 1-year updates, the extra years, a separate performance obligation, etc. So kind of think about what it comes with, what it doesn't come with. Next one. So we're in step 3. So what makes a contract? A contract that you agree to those things. You have some consideration. It does have commercial substance. Dang, I'm not very good at this. The parties approved it. Identification, payment is defined, and we can collect it. And then we have the second step of separate performance obligations. A lot of times it's just whether you're buying the bundle as one thing. Can you separate it? Can you not separate it? And so we're going to get into warranties. Sometimes you can buy the warranty that comes with it, and sometimes you get an extended warranty with it, and those are two different things. There's those two examples. Now we're going to determine the transaction price. Again, most of these are pretty easy because in financial accounting, we just simply, in intermediate accounting, we've sold things and the transaction price is just what they asked for it. But we have also done some other things, like we have sold something, let's say sold a piece of land or sold some property that they're going to pay $1,000 a year for the next 5 years, and we'd have to bring it back to the present value to take out the interest. So that's what we're going to talk about here. So it's the amount of consideration a company expects to receive from a customer. The contract is often easily determined because the customer agrees to pay a fixed amount. So when you go into a store, you buy something for $10, it's stated on there, that's your transaction price. But we also have some other things like variable consideration, time value of money, any non-cash consideration, and consideration paid or payable by the customer. Again, this chapter is about revenue recognition. So instead of going through here thinking it's new, think about, oh, I already know that. Now I'm just learning that it's part of the revenue recognition standard. And that's why we're talking about it in this chapter. So first of all, what is variable consideration? Variable consideration might include any discounts. So I might have a trade discount. I might have some rebates, any credits, any performance bonuses or royalties. So what a performance bonus is I might buy something, I might buy your company from you, and I'm going to pay you $100,000 for your company, but you're going to still run the company. And if you increase sales by 10% next year, then you will earn the bonus. So the question is that bonus, I'm not paying you a bonus salary, I'm paying you a bonus for your company. And so how do I factor that into the selling price if I give that? Any royalties that I sell you an item, but I also get 10% of the sales revenue each year. What we use under this are two amounts, the expected value and the most likely amount that we're going to recognize as revenue. Okay, so I think we have... Okay, so the expected value, we're going to weight it. I think an easiest way to do that is actually do it. So note, when we go later in our examples, you might come back underneath here where you put expected value and most likely amount and give yourself some, right down here, we're going to do them. Okay, so in the expected value, you have this one. Peabody enters a contract with a customer to build a warehouse for $100,000 with a performance bonus of $50,000 that will be paid on the timing of completion. The amount of performance bonus decreases by 10% a week for every week beyond the agreed upon completion date. The contract requirements are similar to contracts that Peabody has performed previously, and management believes that such experience is predicted for this contract. Okay, so if you read through it again, we're technically going to pay them $150,000 if they get it done by the contract date, but we're going to, $50,000 of that is a bonus, and it's going to be decreased by 10% a week. So for instance, if we had, we're building the schools and we wanted them ready by the day school started, we're going to pay them amount. But if they're not ready, we're kind of a little bit upset that it's not ready by the time school started. So we're going to take off some of that bonus. So make sure you word your contract that it's $100,000 plus a bonus of $50,000 that's reducing. Okay, there's a 60% probability that will be completed by the agreed upon completion date, a 30% probability of completed 1 week late, and a 10% probability it's 2 weeks late. So notice these add up to 100. And so what do I do with this revenue arrangement? You actually weight this bonus based on the probability. Right there. Okay, so we have 100,000 plus 50,000, so there's a 60% chance of that. So we have 90,000 there. There's a 30% chance that the bonus will be decreased by 10%. So you could, if you feel better about it, you can say $100,000 plus $50,000 equals $150,000 times 60% is 90. You can have $100,000 plus 90% of $50,000 is $45,000 is $43,500, and then the other one that is $140,000 we're going to lose. I forget what it said. 10% probability, no, 10% a week. It's going to be decreased by 10% a week. So we're going to decrease it by 20%. So 20% of $150,000 is $10,000. So we're going to only pay them $140,000. There's a 10% chance of that. So I book my revenue at $147,500. Okay, so notice it's kind of a weighted average of all these. Now, granted, I'm not going to ever receive $147,500. So when I actually get my cash, you're going to see we're going to have to make some adjustments for the fact that I either got $150,000, $145,000, or $140,000. Never will I get $147,500. So I'm going to have to adjust it when I actually get paid. Okay. The most likely outcome, I would just simply record the $150,000 because it is the highest probability. Okay, so when we talk about variable consideration, hopefully you now can understand what variable consideration is. Variable consideration is I'm going to get paid a different amount based on something that varies. So whether they pay early or not, with the 210 net 30, whether they take the trade discount or not, whether they get it done on time or not. Okay, so you only allocate variable consideration if it's reasonably sure that you will be entitled to the amount, and you only recognize variable consideration if they have experience with similar contracts, and we can make an estimate, in other words. Okay, if you do not meet these criteria, then your revenue recognition is constrained. You can't do it. So anyway, we don't want to recognize revenue that we won't meet. So if we go back to this, okay, I don't know if you've ever had contractor build anything for you, but if contractor has never been early on a job, then they cannot recognize anything but $100,000. But if they have some experience where they generally do this type of thing, then you would do it one of these two ways: the most likely or the probability. Now, you have to know how to do these, but quite frankly, as far as revenue recognition, you have to be told which one you're going to be used. In your business, the hard part is trying to figure it out. All right, time value of money, we've actually done these quite a bit, so hopefully this one will be easy. We need to take out the interest and record it at the present value. So on July 1st, SEC sold goods to Grant for $900,000 in exchange for a 4-year zero interest-bearing note with a face amount of $1,416,000. The goods have an inventory cost of $590,000. So I'm going to jump down to this journal entry. Cost of goods sold and inventory is $590,000. I know that I sold goods for $900,000, so my sales revenue is $900,000. My notes receivable is $1,416,000. So my discount on my notes receivable is $516,000. So notice they gave me the amount for the goods. If I didn't have the amount for the good, I draw out my little timeline. I have $1,416,000 there. It says a 4-year zero interest-bearing note, but I would have to know what the market rate of interest is. I'm going to completely make up this interest rate, but let's say I have borrowed other money at 10% interest, so I'd bring it back by the present value. So I'd want the present value of this for 4 periods, 10%, and I'd find the factor for that and take 4,116,163, bring it back, and I would get 900,000. Okay. Don't look that up. I don't know that you get 900,000 because I just pulled the 10% out of the air, but whatever interest rate we would bring back. So if they didn't give you this 900,000, they have to give you a market rate of interest. This zero interest bearing note means I don't have to do another time value of money for interest payments along the way and bring those back too. Okay. So anyway, we have done this. We just probably haven't done this part of the entry because in our other circumstances, we had, instead of sales revenue, we had cash. And we probably call these investment in notes or investment in bonds, but we had cash there instead of sales revenue. We could have given them land and got exchanged for a note. So in this case, we just sold something and they're going to pay it for us. Okay, so then on December 31st, I need to amortize my discount, so I have get rid of my discount. Let's go back to this in a second. Notice my discount is credited, and it's 4 years, and so principal times rate times time. I have my interest revenue, 900,000, which is carrying value. Notes receivable minus the discount, right here, is 900,000. Just in year one, it's 900,000. Carrying value times the interest rate. So actually in my time value of money, if I would have brought it back at 12%, I should get 900,000. I don't know if the book actually looked that up when they made the problem up or not. But then I have interest revenue. Quite frankly, the big mistake made on these is putting interest expense on instead of interest revenue because your mind is thinking bonds payable a little bit. Okay, so notice my revenue recognition is I record why it's in this chapter is I'm concerned about the 900,000, and in this entry I'm concerned about the interest revenue that I've earned. Okay. When do you not have to use the time value concept? When the amount of time period is less than a year. Okay, or the amount of interest is so immaterial. Okay. Next one, non-cash consideration. We have done non-cash consideration a lot. You have just don't really think about it that you did it. But remember that you record the value of the property given or received, whichever one is more apparent. And so that's non-cash consideration. So companies receive contributions, donations, gifts. Sometimes they contribute goods or services. such as equipment or labor, etc. So maybe you mow my yard and I cut your hair or something like that. And basically, we recognize revenue on the basis of the fair values received. Okay, and you can apply the normal rule of you recognize revenue at the one that's more apparent of whether you gave or received. But I guess in revenue recognition, you want the fair value of what is received. Honestly, if you don't have that, you have to get the fair value of what is paid. Okay, so you just need to do that. What is non-cash consideration? So if I received land and gave you a car, that's non-cash consideration. And again, you just record the transaction, but instead of using cash, you give whatever you got or received instead of cash. Next one, consideration paid or payable. We're still in step 3, determining the transaction price. So we have, let me pause this. I wanted to come back to this one. So notice under step 3, determining the transaction price, we have variable consideration, the amount that varies if they do something or don't do something. The time value of money, this one we just went through, that if they pay us at the end, then I have to bring the amount back to today to determine the selling price and take out the interest. What about non-cash consideration? So what if I give them work in exchange for it? So again, you mow my yard, I cut your hair, etc. That's non-cash consideration. What do? And we record the value of the item given or received for it. Generally, the better one is the item received. And then the last one is considered payable, consideration pay or payable. That's really kind of a strange name for it, but we'll talk about that. Okay. So consideration paid or payable are discounts, volume rebates, coupons, free products or services. And basically these reduce the consideration received and thus the revenue recognized. So for instance, this one, if you go into a car lot and the sticker price is $30,000 and you bargain for it and buy it at $25,000, you record it on your books. Your books is debit card for $25,000. I bought it. Sticker price was $30,000. I bought it for $25,000. So on our books, we debit car for $25,000 and credit cash for $25,000. But I want to flip and talk about the car dealership's journal entry. And the car dealership's journal entry mirrors yours. They're going to credit sales revenue for $25,000, not the sticker price, and debit cash. So these elements reduce the consideration received, debit cash for $25,000, and the revenue recognized. Credit sales revenue for $25,000. So all discounts do that. So next one, this one. Samsung company offers a 3% volume discount if they purchase at least 2 million of its product during the calendar year. On March 31st, they had 700,000 of sales in the previous 2 years. Samsung sold over 3 million to Arctic in the period April 1st to December 31st. So how much revenue should be recognized? So if you look at this one, you're going to say, I don't know at this point in time if they're going to sell the 2 million because I've only got 700,000. Here's the kicker to it. In the previous 2 years, they had made the 2 million and thus got the discount. If that statement had not been made, if in the previous 2 years they had not made the 2 million, this entry is 700,000. But since in the previous 2 years they've made the $2 million, I record it net of the discount. So I have 679,000. If indeed they don't make the discount, then they're going to pay me an additional, and I'll add that to the sales revenue and accounts receivable in the period of time when I figure that out. Okay? So, guess we're probably going to do that right here. Okay, so this one, what if they make the volume discount and I debit cash and credit accounts receivable? What if they don't? I debit cash for 700,000, credit accounts receivable, and I credit sales discounts forfeited. Sales discounts forfeited, if you think about that one, got to be a revenue account. Okay, so if you want to put sales different discounts forfeited revenue, you can, because think about it. I recognize revenue here of $679, and I just got an additional $21,000, so that one has to be a type of revenue account. Next one, step 4. So please go back and look at your steps on your handout. You've got it in front of you, so that's going to be easier than me scrolling back up. But notice how we're now down to step 4, and think about the different things you've had in step 1, 2, and 3. This is no different than we've done over and over and over again. We do it proportionally based on their fair values. The best measure of fair value is what the company could have sold the goods for on a standalone basis. And if you can't have it, you guess, but make a good guess on it. Okay? So we're going to do that one here. Let me find it on my handout, or maybe I have it someplace else. Guess I have it right in front of me. It's just a long problem. Samsung Handler Company is an established manufacturer of equipment used in the construction industry. Their products range from small to large individual pieces of automated machinery to complex systems containing numerous components. The selling prices range from $600,000 to $4 million and are quoted inclusive of installation and training. So notice that includes installation and training. So that's going to be our question. Is the sales separate from the installation and training? The installation process does not involve changes to the feature of equipment and does not require proprietary information about the equipment in order for the installed equipment to perform specifications. Basically what they're saying here is anyone could install this. You do not need our people to install it. You could hire someone else to install it. Okay? Try to get this going. Have the following arrangements. They purchase the equipment from Handler for a price of $2 million and chooses Handler to do the installation. So we have hired them to both buy the equipment and do the installation. They charge the same price for the equipment irrespective of whether it does the installation or not. Some companies would indeed still pay $2 million for the equipment because they would prefer their own employees do it and to do it right. The installation service included in the arrangement is estimated to have a standalone selling price of $20,000. Okay, they have the following arrangements with the company. The standalone selling price of the training session. So again, if we go back to this one, we're selling them. We have installation, and we also have training. Okay, I forgot about reading that up here. It says, I guess it says, and training. The standalone selling price of the training sessions is $50,000. So please take a second to write this down. Purchase price of the equipment is $2 million with the installation, $20,000 for the installation, and $50,000 for the training. They're obligated to pay the $2 million upon delivery. They deliver the equipment on September 1st and completes the installation on November 1st. The training is completed and lasts for 1 year. The equipment has a useful life of 10 years. So hopefully you haven't forgot by now that we're recording the sale, not the purchase of the thing. So let's go through the steps. You have to write down here. What is the performance obligation or obligations for accounting? The primary objective is to sell the equipment. The other services, installation and training, can be performed by other parties if necessary. Notice it says other companies can also perform these training services. As a result, the installation, equipment, and training are 3 separate products or services, and each of them has a standalone selling price and is not interdependent. So if we went back and we changed this and said installation is integral in this, and we have to install it because the seller has to install it because the seller has to test it, as in the case of the installation of QU's Genzabar. But however, remember, QU can also purchase, includes, I believe, some basic training, but then you can purchase additional training. But these are 3 separate performance obligations. Okay, so what's the performance obligations for purposes of accounting? We have 3 separate ones because they can be separated and sold separately. You do not have to get them. Okay, so the equipment, notice that the total revenue should be allocated to the 3 components based on their relative standalone selling prices. In this case, the standalone selling price of the equipment is $2 million. The installation fee is $20,000 and the training fee is $50,000. The total standalone selling price is $2.7. Okay. In this particular one, the one thing that I think is a little bit tricky that you may argue with, you may say you may want to put this at $1,980,000 because it includes it, and $20,000. But remember, you have to pay $2 million for the equipment, and you can decide not to use the installation. So the equipment still has $2 million. So we're paying basically $2 million to get something worth $2,070,000. I think I would need to go back. I read it quickly, and it says, and are quoted inclusive of installation and training, so that these prices include installation and training. Okay. So anyway, now I allocate it based on a ratio. I've got 2 million. I would put them out here. 2 million, 20,000, 50,000, total up to 2,070,000, and then I would just do the ratio of 2 million divided by 270 times my purchase price. So I get that, etc., etc. Okay, so write that down there. So it looks like we're going to make the entries here in B. So I get cash of 2 million, and then I'm going to allocate the revenue based on these 3 numbers to service. This is our training part. It's unearned because I haven't done it yet. So if you go back to the original problem, it says they deliver the equipment on September 1st and completes the installation on November 1st, including the installation, and the transfer of control is complete. So upon November 1st, I have earned the revenue for the building, the services, whatever I bought, the training, the equipment, and the installation. However, I haven't done the training yet, so it's in unearned. Assuming the cost of the equipment is $1.5 million, I don't know that they said that up there. I think you should go back up here and add it. Cost of the equipment is $1.5 million, and I have cost of goods sold inventory. Handler recognizes the training revenue on a straight line basis over 12 months for 1 year. And notice that I did it on November 1st, so as of December 31st, I've had 2 months. So 48,309 divided by 12 months times 2 is 8,052. And then the next year I'd recognize the rest of the unearned revenue. So I did the other 10 months in 2018. There we go. You've done a lot of that before. It's just you have done this when I purchased land and buildings. It's just a few little things that you need to tweak because I don't have cash in the situation. I have earned revenue instead of cash, and sometimes they're flipped. Just if you really think about some of the things we've learned in past areas, it's just a matter of getting in your head straight and recording them a little bit, keeping track of them. Whereas before, let me go back to this one. Generally with the purchase of fixed assets, I debited land, debited building, credited cash. Here I'm debiting cash because I'm getting it, and these are the things, are the revenue I'm allocating it between. So it's exactly the same, but please don't do it quickly because you might get your cash flipped and you might get a little confused that I'm earning revenue on it. Okay, let me pause to get back. This really helps. I was really brilliant when I wrote down slide 42 there. So recognizing revenue, the company satisfies its performance obligation when the customer obtains control of the goods or service. So notice at November 1st, I turned it over to them, and at the end of the year, I'd earned 2 months of the I'd done 2 months of the training, and the next year I did 10 months of the training. So here's some change in control indicators. The company has a right to payment for an asset. So let me give you a couple of these things, which we'll get into over here. But I have it. You owe me for it because I have put it, I've tried to give it to you, but you're not there. And you can't pick it up today because you're on vacation. So I set it in a place, and let's say I'm going to charge you insurance for it. I'm not exactly happy that I still have the product, etc. When I have right to payment for the asset. So notice these are indicators. These are not a list that you have to fulfill. These are indicators that, okay, if I've have several of these or one of these really strong, I have earned my revenue. The company has transferred legal title to the asset. So again, if you have bought a car from me and I've said, please come pick it up on Tuesday, and I have mailed you the title, okay, because I have your cash, okay, and you just can't come for, let's say you had something come up in your life and you can't come and get it, technically you have legal title and I've already got your payment. The company has transferred physical possession of the asset. That's an indicator. The company has significant risks and rewards of ownership. So in other words, you're the person who is now insuring it, and the customer has accepted the asset. So they walk out of the store with it. We're going to talk about some problems with those. Okay, so this one, sometimes you can recognize it over time. We've already done that with our training. And I'll just let you read through these. The identify the contract, that's just kind of a summary of what we've done. Okay, so this is the next section that we're going to talk about. And I think I'm going to stop here and make a separate video on that one. So